Good afternoon, everybody, and welcome to the November market update with the infamous Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide, and I will talk about Mike Ott here for a minute because I don't have to do any credit rules, right? So, for those of you that don't already know Mike, and most of you do, he is a former public school teacher and has been in the mortgage industry for well over 20 years now. With his educational approach and exemplary business reputation, Mike is loved by his clients and agents, which is proven in the fact that most of his business comes from referrals. And I like Mike because he's never he never makes anybody feel anxious. He might need business, but you never know it. And I like that because he calms everybody down that he works with. He's just very calm and thorough. And I just always like those kind of people because I tend to be a whirly whiz. And yeah, I just think that's really great. Plus, then people aren't making wrong decisions. He's keeping them on track to make the right ones. So Mike comes to us today with the wonderful monthly update, market update, which should be interesting yet again this month. So take it away, Mike.
Thank you, Cindy. We'll see if we'll keep it calm, right? Keep calm, move on. Thanks for joining us this afternoon, guys. We'll start where we always do with the rate ranges for the loan products. Conventional conforming, and we'll look at the candlestick chart here in a second. And I'm going to show you that we're just like in this super tight channel, and rates really haven't done much in the way of improving, and they also haven't worsened since the last meeting. Rate really been stuck kind of within a range. And the range is the rule. The breakouts are the exceptions. But when we look at the programs, conventional conforming 6 to 6.5, when you jump up into the high balance or the jumbo conventional world, you're like 6.5 to 7. When we jump over to the Govy products, VA loans 5 3/4 to 6 1/4, FHA and USDA about 6 to 6.5. Mortgage News Daily mortgagenewsdaily.com does a great job of kind of tracking the national averages. And again, I always let you guys know that's free. You don't need to log in. I I have my mortgage clients tell them, hey, you want to know where rates are? This is your best free resource that's out there. They do a really good job of it. All right, so look at the charts. Mortgage-backed securities. Uh, I did my bold horizontal. I mean, look at that. I mean, since really the beginning of September, what a range it's been in. Now, what we look at is when this range goes up to the top of the range, that's when rates are at their best. And then when it goes down towards the bottom of the range, that is where rates have worsened. Now, that's normal movement. It looks like this big kind of peaks and valleys, but it's really not that big of a movement from top to bottom. And I always mention this works inverse to the rates that the consumers are offered, right? We want to see this mortgage-backed securities chart go up, and we want to see way more green, right? Green is good, up is good, red and down, not so good. And obviously we were, and it just kind of ebbs and flows. When people talk about the technical aspects of the market, staying in this range, I mean, it's doing exactly what the technicals would suggest. It's going to take something big news-wise, economic, labor report to break one way or the other, right? And obviously, we're going to remain optimistic that, we get a break and see this chart kind of take off in an upward trend with many, many more green days, because that means then that the rates offered to consumers are priced more favorably and have a downward trend themselves. All right, any questions on that? That's the mortgage nerdy stuff. Now, in the midst of the shutdown, which thankfully is over, we're lacking a lot of data. The Federal Reserve is lacking a lot of data because we didn't get stuff for a month. What we did get is what I put on the slide, and some things are different and they're not the normal stuff because I'm pulling in some other more private sector reports that don't come from the Bureau of Labor Statistics. But we did, since we last met, we did have consumer price index inflation data came out, and it was arguably pretty tame. It was up 0.3. The market was looking for 0.4 of an increase. And you know, our year to year, or excuse me, our year over year numbers stayed at 3.1. Now remember, the Fed pays more close attention to PCE inflation data, but they look at this as well. And obviously, when you look at the 3.1%, right, the thought is, okay, well, everybody knows the Fed wants to be at 2% is the target. So the mindset is, or you know, the vibe out there is that we're still, you know, way over. Again, we've talked about the flaws in some of this reporting. We've talked about how shelter is probably one of the largest components of both CPI and PCE, and there are extreme lags in that. We are seeing shelter numbers come down, but when you look at real-time rents compared to what's on the most recent CPI, and I'll be curious to see what we get once we get the PCE report. You know, will we see a further reduction in those numbers? We're expecting them to come down, but again, they don't come down as quickly as some of the real-time data that you might get, let's say, from like Zillow or Redfin, who their reports are more in the here and now and have a finger on the pulse. Now we did get, because again, ADP is not coming from the government, we did get the ADP employment report on November 5th. It showed an increase of 42,000 jobs in the month of October, which was above the expectations of 25,000. Now, the market didn't, you know, or I'd say this didn't help interest rates, but you have to think if we're coming out of an environment of the last few years where we're talking about hundreds of thousands of jobs being created month over month, and now we're getting a number that's 42,000 in the private sector. Yeah, the expectation was low. 25,000 was probably an easy number to beat, but 42,000 is still pretty anemic. And you know, my hope is that, you know, the markets and investors are not ignoring that and thinking, oh, this is a home run number, because it's very, very far from it. The previous month's figure was revised higher. Initially, it came out, there were 32,000 jobs lost in the month of September, and they revised that to 29,000. Again, 4,000 difference. Still, it's jobs, it's private sector jobs lost. Now, the Challenger job cut is one that we don't usually look at, put on here, but it does count corporate layoffs based off mass layoff data from the state departments of labor. Now, this showed that there were 153,074 layoffs in October, and that's up from 54,064 cuts in the previous month. This was the largest October layoff report since 2003. If you're sitting there feeling like when you hear headlines of Amazon laying off 15,000, Microsoft another X number of thousand, this is the real time data that we can only hope that the Federal Reserve is paying attention to, right? Again, historically, the Federal Reserve, the error in what they do is that they make decisions about moving forward by looking at data in the rearview mirror. Yesterday, initial jobless claims came out. Now, it was kind of shrugged off because it's like, oh, well, because of the shutdown, this was the these were the numbers that were expected to come out right before the shutdown, and they never came out. So these are for the month of, actually, these should be September numbers. So we're looking at 232,000 claims for the week, but look at the continuing claims. Man, we're rounding up to 2 million. Right? Remember, this is a weekly report on jobless claims. So 2 million in continuing claims are again arguably just just shy of 2 million. That's not good. ADP came out yesterday with a weekly preliminary estimate of employment. It showed an average weekly decline of 2,500 jobs in the private sector in the 4 weeks ending November 1. This suggests a total loss of 10,000 jobs over the 4-week period. And we're a day too early from the biggest news, and the biggest market mover is tomorrow. We will get, and I'm sorry, I said in the initial jobless claims that were September numbers. No, that what's in print there is correct for week ending October 18th. Tomorrow's BLS jobs report for non-farm payrolls will be for September, right? Because we didn't get it because we would have gotten it early October and early in the month, and that's when the government shut down and basically paused this. What we are waiting to hear, and it's one of those things where you just kind of have to check on it, keep your ears open, is how quickly will BLS get caught up and get us October's numbers now that we're, more than midway through November. Hopes are that we get this report. I hope we get a report before the next Fed meeting, which is, the rate decision is Wednesday, December 10th. So tomorrow morning at 8:30, that is a heavily anticipated report. Some economists feel like, regardless of what it is, that the markets might shrug it off because it's stale, because it's September data. But if it shows weakening in the labor market, and the expectation is that it might, if it all aligns with anything that we're getting from the private sector, we should see some more labor weakness. And remember, we'll get the unemployment rate updated with that report tomorrow morning as well. Friday brings some inflation on the wholesale side, but the Michigan Consumer Sentiment survey will come out, and that has not been rosy, right? That's where you get the general public's opinions on economy, on inflation. And if you've heard anything in the news, that that's a pretty sour sentiment that we would expect there. Any questions on the market moves? I think just keep your ears open. I still think more of this is coming. You've got retailers that are not going to hire additional employees during the holiday shopping months. Okay. Now, the American consumer is still expected to spend $1 trillion in the holiday season, but that's what Americans do, right? But when you have the employers saying we're not taking on additional staff, they're expecting probably less foot traffic, but they're also trying to preserve margin. So it'll be interesting. It's going to be an interesting next 30 days, till we get to the middle of December and we're past the next Fed meeting. Because before the shutdown, it was baked in. We were going to get 0.25% reduction in the federal funds rate at the December meeting. And then Powell spoke at the last press conference and basically stopped that fire out and said that a December rate cut is no foregone conclusion. And he decided to follow it up with, the comment of, not by a long shot, is what he said. And that's what caused, if we go back to charts, that's your day right here. Your end of October, your big red day. That's the Fed meeting. So again, I further emphasize this, right? Just because the Federal Reserve lowers their federal funds rate, this was a horrible day for mortgage rates. Right? The Fed does not control mortgage rates. What they do to the federal funds rate influences how the markets react and what investors do with their money. And they did not like hearing that the Fed rate cut that was so expected and anticipated for December is now in question. All right, local. Northern Virginia area median price 750. That's up 4.9% year over year. Total sales up 7.5 year over year. We look at Prince William median price 570. That's actually dropped though. It was like 575 last month, but sales up year over year 3.6. Total sales not so good, down 5.9% year over year. Dulles area median price 757, 149. That's up 6.6% year over year. Total sales up 4.8. And Dulles still not updated. That's September. Lending news. There's not a whole lot of earth-shattering stuff going on. I think last month I may have told you the Federal Home Loan Bank, had another surplus of funds that they spread out to the banks and was good for their federal home loan first-time homebuyer incentives. I think we got the email that the money was there Monday during that week, and Thursday we got an email that the money was gone. So that's how quickly that goes when it comes. Big news, you may have heard Fannie Mae is removing the minimum credit score requirement. That was effective over this past weekend. The hard minimum before was 620. Basically, you couldn't do a conventional loan with a middle score of 620 or less. They are now DU stands for desktop underwriter. That is the automated system that we lenders use and run the loan scenarios through. That's the system that says, yeah, this is a good loan, or no, this one doesn't make the cut. So desktop underwriter is going to use its internal risk model to evaluate loans eligibility based on a comprehensive analysis of borrower's financial situation. Now, I got a lot of questions, a lot of comments, a lot of people that, will say things to me because I'm in the industry. I say, that's kind of scary because you're automatically led to believe that, oh, well, now Fannie Mae is just going to give mortgage loans to people with lousy credit because they removed the minimum. No, I would be willing to bet that internal risk algorithm isn't changing, right? It's not changing. Now, what I do think that will be built into the algorithm to give some people with lower credit scores, or let's say a sub 620 score fighting chance, is that we may get to a place where the algorithm now, you have more than one borrower, and let's say you have a borrower potentially with a higher credit score and one with a sub 620, that will lower risk because there's two borrowers, two incomes, potentially two incomes, right, to offset that lower FICO score of the one borrower. I think we're going to see some of that. I think we're also going to see some of that when the mortgage industry fully kicks into gear that Vantage score 4.0, and it's accepting that and not just a traditional classic FICO score from lender credit report. So a lot of this is in the works. It will remains to be seen how it all plays out. This broader eligibility, right? Yeah, it sounds good. This system is not foolish enough to just start approving borrowers and approving them for money that they realistically cannot repay. I think it would be far from them. So again, to me, in the industry, being in it for 20 years, it's not a big news event, but it made some headlines, maybe something that you guys Because credit scores still matter, right? They're still relevant. They're not being eliminated, not by a long shot. And then you have to be careful because even though Fannie Mae might open the floodgates and let's say let a 619 or 615 score go, lenders can always self-impose their own credit score overloads, right? And say, we as a company, even though Fannie Mae might find this loan scenario to be what we call approved eligible, those are the words that the findings come back with. That's the two magic words we're always looking for is approved eligible, right? That's what we want when we run these through. Well, they might say approved eligible at a 615 score, but maybe the lender, the company itself doesn't want to carry that risk. So you just have to, keep your eyes and ears open, see what the lending institutions are doing. But that's Fannie Mae's kind of baseline new announcement. And hopefully we'll be getting soon the updated and increased conforming loan limit. The anticipation is that's going to go from 806,500 to 819,000 flat. Okay. That usually gets announced by Fannie Mae and Freddie Mac and the Federal Housing Finance Agency around the time of Thanksgiving. So we're close. Right? We're close. And again, what that means is they're just raising the bar. It means there's been enough appreciation on a national level to warrant moving that conforming loan limit up a little bit. And then that means going forward, everything that's $819,001 and higher in loan amount will be that high balance of jumbo loan. So I would anticipate next month we're going to be have that official announcement. All right. Well, has anybody heard about a 50-year mortgage? It's going to save the day. It's the answer to the affordability crisis. Here's the numbers. Okay. On the left-hand side, we've got a 30-year mortgage and I've done a 50-year. I want to embed the narration here of like why I put what's in here. Now I did this at 700,000 purchase price. That's the same for both scenarios. 10% down, so loan amount 630,000. That's the same. Now on a 30-year market's oscillating right in that low to mid sixes. I use 6.25. So on a 30-year fixed rate loan, you're all in principal, interest, taxes, and insurance, right? And monthly mortgage insurance, $46.84 and 2 pennies per month, right? Cash to close, $93,922 and 48 cents. That is the 10% down plus the closing costs. All right. Now, if they were to they flirted with 40-year mortgages as a non-traditional mortgage product back in the 08, 09, housing mortgage meltdown. And the rates on those 40-year loans were easily 0.5% higher than the 30-year rates at the time. Now, that didn't last. So this idea of a 50-year mortgage, you have to understand that from the lender investor standpoint, wait, I'm going to have this note out there for 20 years longer than this traditional 30-year, right? It's going to present more risk. Well, what do lenders do when it's riskier for them to lend or a riskier product for them to lend? They increase the interest rate. So I'm putting in there 7.25 with the firm belief that if this were to come to fruition, that you would see 50-year mortgage rates at least at a minimum 1% above the market rate on the traditional 30-year fixed rate loan. So when we use 7.25, our payment all in DITI 47.16 and 63 cents. Cash to close is a little bit higher. But look at the payment. That green monthly, this down here, $32.61. That's the monthly savings. Hot dog, that'll do it. That'll get more buyers off the fence. And I'm not, again, I think it's, uh, I don't know where this is going. I, I have my doubts personally. Um, because when you play the numbers out and this is what you see, um, $32.61, is four less Starbucks coffees a month. It doesn't move the needle. Look at the savings in the first 5 years. A little over $36,500, right? Arguably 36,600. Now, the green bar graph. Well, Mike, why didn't you do it over the whole 30-year term and really make us sick to our stomachs? Well, because the reality is whether you do a 30-year mortgage or a 50-year mortgage, if it becomes available, you're probably not going to be in that long, not long. And now, traditionally, our borrowers would stay in a mortgage loan somewhere between 5 and 7 years, right? Well, that tide has shifted, and what caused it was super ridiculous low rates during COVID, and now you got people that aren't moving, not listing their house, and they're staying put, or not doing their move up buys because they're held house hostage by an interest rate that starts with a 3 or 4 handle. So the trend is getting closer, right? It's above 7 years, let's say, on an average. So I chose 10 years. But I just wanted to show you that if you were in the 50-year loan and could have done a 30-year loan, you would pay $86,452 more in combined mortgage interest and mortgage and PMI, mortgage insurance on a conventional loan. And that's in a 10-year period. So you can probably imagine what that number is going to look like over an entire 50-year term. So thought that was enough to kind of paint, because again, came out, was in it's been in the news. You've got people that are bashing the idea. You've got some people that think, hey, it gives people another option. If it becomes another option, it becomes another option. I look at it as if it's ever a make sense option and it becomes available product, my job and duty as a loan originator, and I have borrowers that would qualify for it or might benefit from it. It's my job to share that to them as an option. So we'll see, right? But on the surface, knowing that the rates will be higher, right? And it's not your month to month, right? Right now, they're trying to find a cure to solve the monthly payment. And this, as you can see, just probably isn't going to do it. All right. Lisa, you had a question in the chat. Hi, Lisa. How are you? Will the credit score still be considered for the grants? So let me answer this just through Virginia Housing. They have not published any guidance yet. What Virginia Housing typically does is they typically follow agency when they make changes, but that's a really good question. We don't know yet. We don't know yet if it's going to impact your first-time home buyer grant programs at the state level and the state programs. It'll be interesting because again, when they make changes before, they increase loan amounts and things like that. Virginia Housing usually follows suit. Whether they do so on the conventional product that is either tied to the grant program or the down payment assistance, we'll have to wait and see. I've not heard anything for sure, but that's a really good question. So I'm glad you brought that up, because I got to keep my eyes and ears open for it. Any other questions? Any other thoughts on the 50-year mortgage? Good, bad, or indifferent? I think the numbers suggest that it could potentially um fall on its face, but I also doubt that it'll ever come to do it.
I have a question, Mike. Do you think you're ever going to go back to an interest only mortgage?
Also been in the news. Um, the truth is interest only is still out there.
Oh,
Um, it's not Fannie Mae, Freddie Mac. It's in portfolio lending. It's still there. And now it's nothing like 100% financing 2008, 2001. It's not that. Um, you have to have extremely good credit, have a lot of skin in the game, like 30, 40% down. And then interest only can be an option in the non-qualified mortgage space, portfolio lending space. It does exist. It's not a huge market share by any means. There is an expectation across the mortgage channels that we might see it come back in. I don't know how quickly Fannie and Freddie would be itching to open that up. I do think you'll see maybe more of it in that portfolio become, and I do think you will see it with adjustable rate mortgages. But I also think that if the industry has learned a lesson, that they will look at what the non-qualified mortgage space is doing, and to be able to do those products, that you will have to have a pretty large down payment and be in a very strong equity position to begin with, and have excellent credit scores and low debt to income ratios. I don't think they're going to hand it out just because the mortgage borrower has a tux.
who do you think would be the person who would appeal to? Maybe a retiree who is sitting in a house that's too big for them with a great interest rate, but yet they've got financing, they're kind of set. And it would at least get them out of their big house and let them buy something they just could live in. That would be better for them.
Potentially, I think where interest only is worth its weight in gold, and it's a segment of the population. It's for it, who can maximize it, or high net worth people.
Yeah.
Because they have the money. They're like, hey, give me the lowest, cheapest mortgage, because
Mhm.
that savings, I'm going to redirect and invest those dollars and get a higher rate of return on that money, higher than whatever my interest only rate is. Right? If my interest only rate is 6.5, but I know that in this in the investment world and with my financial planner, I can get 10 to 11% on this money. That's who uses it correctly. I correctly could be um uh I don't know if that's the right word, but effectively maybe is maybe a better word. Um yeah, the problem is people were using interest only loans because the payment was lower and they could qualify for more house, and then housing values tanked because they were doing interest only up to 100% from the value. And I hope that's lesson learned. But I do see that potentially creeping back in. I think we're going to see ARM rates get better sooner than we see interest only come back in um, as a product. That's going to take the Fed continuing to go on their lower. That's a lot of yield curve stuff where the shorter end of the curve is going to come down. And because right now, a 7-year ARM might be a 0.5% better than the 30-year fixed rate. Where that will start cooking is if we see a 7-year ARM rate that's 3/4 to a point better. Yeah. And again, it's the ARM isn't for everybody. Those of you that have been here, and I do an ARM comparison from time to time, and I always let my borrowers know, don't keep it in the wheelhouse as an option. Doesn't mean it's the best option for you or the right option or the one you're most comfortable with, but my job is to let you know what you could do and what's possible. Because when you look at that first 7 years, that's a significant amount of savings on the mortgage interest. Yeah, good question about interest only. That's poked its head up along with the 50-year mortgage this last couple of weeks. Any other questions? That's a good one.
Well, I
Any
had
other
another
thoughts?
boring question. It was more talking, we kind of went through it quickly about what's going on in the local markets. What's going on with Prince William home sales, compared to Fairfax? What's going on there?
So I would lean on you guys more for that if there's a more local expert. I go to the site, pull the data. Prince William's been negative. If you've been here the last few months, Prince William year over year has been down, and I think that's just I think that's the state of the market. I don't know what might be contributing to that. Um, I I don't, to me, it doesn't seem like Prince William would be a less desirable area. I would think that because it might be a little bit more affordable than Fairfax and Loudoun, that maybe our numbers might be better. It is a bit of a head scratcher. Um, and I live in Prince William. Uh, so yeah, I don't think I have a good answer for that, but those year over year numbers have been soft. But in general, I feel like 2025 has been soft overall. Um, oh, speaking of which, because that sounds bad, right? No, we don't want all bad news. NAR just came out, Lawrence Yun, their financial, I forget his official title, guy's great though. Lawrence Yun did the NAR projections for 2026, and it was rather optimistic. Check that out if you haven't heard. Expectations are that he was very clear. He did not see home values tanking. He felt like, I think, 4% appreciation over the next year is very doable. He does expect interest rates to hover closer to 6 than to 7 that they did for the majority of this past year. And that will help for the affordability. But definitely check that out. I think that was a day or two ago. And and all in the same breath, that report could change next month due to market conditions. Right? It's one of those things. But I like the optimism, and I thought, okay, because all you hear about it, you probably heard this week that foreclosures are up. But I think I think that's directly related to the layoffs that we are hearing about, and I think we are going to continue to see, unfortunately. And we'll start hearing the R word, recession, maybe a bit soon. We'll see. Now, that bad news is good news for rates. I always feel awkward saying that, but that's the truth of it. Never want to see, people out of work and struggling financially. But in every recession, Fed changes course, rates go lower because they want to re-incentivize people to borrow money and keep things moving. That's the cycle. Cool. Anything else? But I appreciate you guys coming and joining us. I hope to give you some good, solid information out there, and can't wait to see what we're talking about next month, because we'll be after the Fed meeting, and hopefully we'll get some more of this data, labor data that we were missing due to the shutdown.
Well, thanks, Mike. Thanks, everybody. All right. See you next month.
All right,
Take
take care,
care.
guys.
Okay, bye.